People talk about buying stocks all the time, but what does that really mean? Let's make it super easy to understand. When you buy a stock, you own a small part of a company. Let's say you owned half of YouTube's stock. That would mean you own half of YouTube. A share is just one piece of that stock. So if there are 10 shares total, and you own 5 of them, you own 50% of the company. A stock exchange is like a marketplace. It's where people buy and sell company stocks. Big ones include the New York Stock Exchange and the NASDAQ. You can think of it like Amazon, but instead of buying clothes or gadgets, you're buying tiny pieces of companies. Companies sell stocks to raise money. They might want to grow bigger, launch new products, or open more stores. When you buy a stock, you become a part owner. That makes you a shareholder. Let's say Antonio wants to open a pizza shop. He needs $100,000, but he only has $50,000. So what does he do? Antonio has several options to finance his business. Venture, like taking a loan from the bank or finding investors. He decides to find investors who want to support his business, so he sells ownership in his pizza restaurant. He divides the ownership into 10 small pieces called shares and sells them to interested investors. Since the total cost is $100,000 and he already has $50,000, which represents 5 shares or half of the total ownership, Antonio sells the remaining half ownership in 5 shares, making each share worth $10,000. Now meet Alex. He loves pizza and buys 1 share for $10,000. That means he owns 10% of Antonio's pizzeria. Antonio sells the rest of the shares too and gets the remaining $50,000 he needs to start. 5 years later, business is booming. Antonio's pizzeria is now worth $300,000. Alex's 10% share? Now worth $30,000. He made a $20,000 profit. But if the business had failed, let's say it dropped to $80,000, Alex's share would only be worth $8,000. He would lose $2,000. That's the risk of investing. If Antonio's pizzeria keeps growing, he might take it to the big leagues. He can list it on a stock exchange, like the New York Stock Exchange or NASDAQ. That means anyone can now buy shares of it, just like they buy shares of Apple or Google, because they hope the company will grow. If the company does well, the stock price goes up. You can then sell your stock for more money. Some companies also pay dividends, which means they give part of their profits to shareholders. The stock market isn't always rising. Sometimes it goes down. Companies might lose value, and you might lose money. It's like a roller coaster. Exciting, but not always smooth. If you're just starting out, learn before you invest. Start with companies you know and trust. Don't put all your money into one stock. Spread it out. That's called diversification. You can buy stocks to trade short-term or invest long-term. I'll explain both in the next video. If you want me to explain more topics like this, hit like, subscribe, and turn on the bell for updates. Thanks for watching.